On this week's Emily Now episode, we've labeled it Don't Get Cold Feet. Commitment can be scary. We're talking about first-time home buying and some of the different things that first-time home buyers should know, including 25-year amortizations, the first-time home buyer plan, walk you through an example of how some parents were able to help their child purchase a property, and then go through an article that was in the Financial Post about homes being affordable, if you can believe that, because of low interest rates. So anyway, stay tuned. We expect this to be a good one. My name is Dylan Gallagher, founder of emilynow.ca. I've been a finance guy for the past 18 years, helping people and businesses do more with a mortgage or a loan, and I've run a brokerage firm for the past 15 years as well. And so we've become pretty good at helping people who need less than $10 million in either a business loan or a commercial mortgage or a residential mortgage. And each week, we put together these emilynow.ca episodes to help those people that are using our online platform understand a little bit more about mortgages and loans, because we believe that if you've got knowledge, you can make better decisions, and that those better decisions will lead you to either save money, invest for the future, or maybe give back to the community around you. So in our small way, we're hoping that each week as you tune in, that you're learning a little bit and that it's time well spent. We would encourage you to check us out on Twitter at @EmilyNowCanada, like us on Facebook, subscribe to us on YouTube, +1 us on Google. We work very hard to put out great content every week to keep you interested, so that every time you come to our social pages that you're not seeing the same thing over and over again. And we try to make it unique every week as well, so that even if you're not interested in commercial mortgages, maybe there's something that you'll find of interest. So connect with us online, send us your questions, interact with our team. We'd be happy to help you. And each episode we answer a few questions that we've either seen come in through the social channels that we're on, or just in regular conversation with our clients. And so today, the first question that we have is a mortgage with an amortization of over 25 years a bad idea? My answer on this is no. It's not necessarily the amortization period that you should be focused on. I'm of the belief, and this might sound strange coming from a guy that's done this for so long, but I'm of the opinion that you probably want to get rid of your mortgage as quickly as possible. What the amortization period refers to is how long of a time period the bank is going to calculate your mortgage payments over. And so it's typical that people will pick 25 years, but you can get more than that. You can get a higher amortization. But at the end of the day, the amortization period means you're going to have a mortgage for a longer period of time. So we're going to have a 25-year mortgage, and you are going to have to pay interest for a longer period of time. So, but the trade-off becomes, in exchange for paying all of that interest over a longer period of time, that your payments get smaller with each period. So at 15 years, your payment might be, this big. At 25-year amortization, your payment will be this big, but you're paying extra interest for longer. And at 35 years, your mortgage payment might be this big, but again, you're paying more interest over the longer period of time. So just to put some numbers to all of this, if you took a $350,000 mortgage over 25 years at 4%, you'd pay over $200,000 in interest. So that means your home, you have $550,000 into your home, not including your down payment, and not including any of the maintenance and repair. So basically, you've paid for your house twice over 25 years, if that's the period. So, and that assumes huge assumption there that interest rates stay at 4% over 25 years, which I think is highly unlikely. But going with the example, you're going to pay for your house twice. So is it a good idea to take an amortization of over 25 years? I would argue it's not a good idea to take a mortgage with any amortization period, but you should get an amortization period that results in a payment that you can afford, and then from there, it's more important to have a plan as to how you're going to pay this mortgage off quickly. So many banks or lenders will give you prepayment privileges where you can pay down a chunk of the mortgage every year with no penalty, or you can increase your payments and have that amount of increase pay off the principal quicker. So a couple of questions that you're going to want to ask yourself when you are considering getting a longer amortization period, or even a 25-year amortization period, which is, will your home rise in value over and above that interest cost that you're going to have? So in our example, we said you're going to end up paying $200,000 in interest. Well, is your home going to go up $200,000? If the answer is yes, then go to town, have a long amortization period. It doesn't really matter. What about your down payment? Are you going to be able to get your down payment back? Meaning, will the property rise over and above the interest cost and the amount of money that you put into the property? What if interest rates don't average out at a constant rate over the 25 years? How's that going to impact the money that you've put into that home? And so there's a couple of questions or a couple of things to consider. To answer the question, is a mortgage with an amortization period of over 25 years a bad idea? We would suggest get an amortization period that today is going to allow you to make the payment, but while you're doing that, make sure that you understand how you can pay the mortgage off sooner rather than later so that you don't end up paying twice for your home. And if you're looking for a mortgage, we'd encourage you to visit emilynow.ca, where you can punch in a mortgage amount, see what your options are, sort of mess around with the numbers a little bit like a mortgage calculator, but then more importantly, you can get a score based on your overall financial picture. You can take that score, which is a representation of the likelihood of you being approved, and then you can see which banks or lenders would approve you and what kind of interest rates and terms they're going to offer you. So get started today. It doesn't cost anything. It's free. And we're going to move right along to our second question, which is, should I be looking into utilizing the first-time homebuyers plan? And my general comment on this is, if you have access to help, take it. Meaning, if you can afford, through your parents, through friends and family, through somebody related to you, if you can afford to use their money instead of borrowing more money from the bank, meaning you only want to put down 5%, then you should do it. If you take advantage of it, you're going to save thousands of dollars in interest costs. And if you're going to put down 20% or more, there's no insurance, so that's a good deal. But if you don't have 20% to put down, you are going to have to pay a premium. So if you've got family or friends that can help you, I would encourage you to take advantage of that help. And so here's kind of how the math works out again. On a $400,000 purchase price, you buy a home for $400,000, you put down 5%, you get CMHC insurance. The overall insurance cost for that home is going to be about $229,000, assuming interest rates stayed exactly the same for that 25 years. But if you didn't have insurance, if you were able to get help from family, friends, or your parents, or what have you, that same amount of interest that you would end up paying is $186,000. So the difference between getting help from your family and friends with the down payment, or just taking 5% and paying the insurance premiums, almost $42,000 over 25 years. Now, you might say, oh, well, $42,000, that's not a big deal. Well, the reality is it's $42,000. I mean, that's 10% of the cost of this example. $400,000 was the home, so $42,000, I mean, that's 10%. I think that is a big deal. And any amount of money that you don't have to pay the bank, I think, is a big deal. And so should you be looking into utilizing the first-time home buyer plan? Our answer is always, if you have help, take the help, because it's going to be cheaper than paying the insurance premium to get access to banks that'll give you 95% of the purchase price. One of the things I want to mention here, though, is you can also get a first-time home buyer tax credit. So that's a credit that you can put on your tax return and save a little bit of money there, but it still doesn't really come close to offsetting the cost of the premium. So if you can get help, take it. You're going to save yourself a lot of money. And if you want to see what the impact of that is, you can jump on emilynow.ca, work your way through the software, and you'll be able to see what your options are and kind of what this math looks like. You can put in 5%, you can put in 20%, you can sort of mess with the numbers and see what comes out on the other side. We've got a great customer service team that would also be happy to help you understand your options, to understand what the difference in math is going to be. There's no cost for using emilynow.ca, and we encourage you to get started today. Our real life example today has to do with a couple I'm familiar with because I know their father really, really well. And these are two students who are just finishing up medical degrees. One will be a doctor, one will be a surgeon, and they just happen to be in this moment right now where tons and tons of debt because of their education and all of the student loans that they've had to take. They've had their first child, they're just about to have their second child, and they needed to purchase a house. And so with the help of their parents, they were able to get the 20% down that they needed so that they didn't have to pay any insurance premiums. And they're able to live in the home, and then as they finish their education, finish paying off, or I guess beginning to earn income to pay off their student loans, that they're going to be able to ultimately get their parents off of the deal. And in our history, what we've seen when parents do agree to help a child buy their first home, that many lenders will give a provision where the parent can come off of the mortgage before the maturity date. So if it turns out that when the child purchased the home, or the child and their spouse purchased the home, that maybe they were just getting started in life, but maybe 2 or 3 years down the road, they're making lots of money, things are working out really well, and the parents don't want to be liable for that mortgage anymore, they can, the people that own the home, the children can apply to the bank and say, look, can we have our parents off of the mortgage? And many people don't know that. So if you have help, take it. If you're going to get your parents to help you with the down payment, that would be a great idea financially. And keep in mind that as you go along, you can always get your parents off of the mortgage as well. And I'm familiar with a young man who has done a few mortgages through us, but when he got his very, very first mortgage, his mom co-signed for him because he was too new at his job and didn't have enough employment history. But a couple properties later, he was able to get his mom off of the mortgage. She didn't need to co-sign, but she was there to help him while he needed it. So if you're considering buying your first home and you're trying to figure out how to put these things together, should I talk to my parents, should I not talk to them? We'd strongly encourage you to get the help that you need because it can go a long way and it can save you lots of money. So if you want to figure out what a mortgage looks like for yourself, visit emilynow.ca where you can put in some numbers, you can change them, you can see what the impact will be, but then you can also get a score based on your overall financial picture, which will help you understand, based on your score, which banks or lenders would approve you and what options you'd have. Financial Post put out an article by Gary Marr which talked about affordable housing, which I chuckle at a little bit because I find housing just simply isn't affordable. It's kind of an oxymoron in my mind. I think that in Canada in particular, in the major centers, houses are just so expensive, and even if you're not buying a home or renting a home, it's just expensive to live. Some of the towns are much, much more affordable, but in general, affordable housing is kind of a funny term for me. But notwithstanding that, the Financial Post Gary talked a little bit about how, or summarized some of the market research out there that says notwithstanding that house prices are rising, that low interest rates are continuing to help people afford properties. And RBC, as mentioned in the article, is saying that historically low interest rates can't be sustained, and they're expecting that the Bank of Canada will begin raising rates in 2015. So if interest rates start going up, obviously affording a home becomes hard. And for those of you that don't know what that word affordability means, specifically the way banks, lenders, the market looks at affordability is they say how much of your income before taxes are being used for mortgage payment, utilities, and property taxes. And typically that's got to be around 40%. So if interest rates start to go up but your income stays exactly the same, it means that now you're spending more of your pre-tax dollars on your home, meaning the houses aren't as affordable as they were while taxes were low. So what can you do about this? If you kind of know that this is coming, if you have recently purchased a home, or maybe in the last few years you bought a home, you have seen that interest rates have been historically low for the last decade, which is true. What you can start doing is just thinking through or having a plan for what happens if interest rates rise. Even if you have a fixed mortgage or a variable mortgage, it doesn't change the exercise. 5 years from now or 4 years from now, when your mortgage comes up for maturity, if interest rates have gone up and your income doesn't go up in the same amount, how are you now going to cover the difference? Do you have to take the money from your entertainment account? Do you have to take it from your groceries? Where do you end up making up the difference? And so don't wait until the mortgage maturity date is in front of you. Begin thinking about it now. And it's probably best to say if interest rates rose another 2 or 3 or 4% even, what does that really look like? That's not to say that's going to happen, but what it does is it forces you to at least be familiar with what your budget is going to look like every month if interest rates were to rise and how much your mortgage payment is going to end up changing. So it's always prudent to have a plan, and in this particular case, if you believe that interest rates at some point during the total amortization period of your mortgage are going to go up, have a plan for figuring out how you're going to make those payments. Is your income going to go up? Are your expenses going to go down? Or what changes are you going to have to make in your budget to be able to accommodate that? So we'd be happy to help you. Obviously, if you think you need a mortgage, jump on emilynow.ca. You can see what's involved in being approved. You can spend a few minutes on the site putting your information together and ultimately getting what we call an Emily score, which you can then use to see which banks or lenders would approve you based on your score, what kind of interest rates you'd be eligible for, and some of the other details like paperwork and questions and so forth. It's free to use, and we look forward to helping you if you end up going through the site. We've got a great customer service team that is there to help. And that concludes this week's Emily Now episode. We look forward to seeing you next time.